The general features of the financial statements are the following: fair presentation and compliance with IFRS, going concern, accrual basis of accounting, materiality and aggregation, offsetting, frequency of reporting, comparative information, and last is your consistency of presentation. First feature is the fair presentation and compliance with IFRS. In here, fair presentation is faithfully representing in the financial statements the effects of transactions and other events in accordance with the definitions and recognition criteria for assets, liabilities, income, and expense set out in the conceptual framework. Compliance with the IFRS is presumed to result in fairly presented financial statements. Fair presentation also requires the proper selection and application of accounting policies, proper presentation of information, and provision of additional disclosures whenever relevant to the understanding of the financial statements. Inappropriate accounting policies cannot be rectified by mere disclosure. The standard requires an entity whose financial statements comply with IFRS to make an explicit and unreserved statement of such compliance in the notes. However, an entity shall not make such statement unless it complies with all the requirements of the IFRS. There may be cases wherein an entity's management concludes that compliance with an IFRS requirement is misleading. In such case, the standard permits a departure from an IFRS requirement if the relevant regulatory framework requires or allows such departure. When an entity departs from an IFRS requirement, it shall disclose the management's conclusion as to the fair presentation of the financial statements, that all other requirements of the IFRS are complied with, the title of the IFRS from which the entity has departed, and the financial effect of the departure. Second feature is the going concern assumption. In here, the financial statements are normally prepared on a going concern basis unless the entity has an intention to liquidate or has no other alternative but to do so. When preparing the FS, management shall assess the entity's ability to continue as a going concern, taking into account all available information about the future, which is at least but not limited to 12 months from the reporting date. If the entity has a history of profitable operations and ready access to financial resources, management may conclude that the entity is a going concern without detailed analysis. If there are material uncertainties on the entity's ability to continue as a going concern, those uncertainties shall be disclosed. If the entity is not a going concern, its financial statements shall be prepared using another basis. This fact shall be disclosed, including the basis used and the reason why the entity is not regarded as a going concern. The third feature is the accrual basis of accounting. All financial statements shall be prepared using the accrual basis of accounting, except for the statement of cash flows, which is prepared using cash basis. The fourth feature is the materiality and aggregation. Each material class of similar items is presented separately. A class of similar items is called a line item. These similar items are presented separately unless they are immaterial. Individual immaterial items are aggregated with other items. The fifth general feature is the offsetting. Assets and liabilities or income and expenses are presented separately and are not offset unless offsetting is required or permitted by an IFRS. Offsetting is permitted when it reflects the substance of the transaction. Examples of these are presenting gains or losses from sales of assets, net of the related selling expenses, Another example is presenting at net amount the unrealized gains and losses arising from trading securities and from translation of foreign currency denominated assets and liabilities, except if they are immaterial. Presenting a loss from a provision net of reimbursement from a third party. Measuring assets net of valuation allowances is not offsetting. For example, deducting allowances for doubtful accounts from accounts receivable, or deducting accumulated depreciation from a building account or PPE is not offsetting. Next general feature is the frequency of reporting. Financial statements are prepared at least annually. If an entity changes its reporting period to a period longer or shorter than 1 year, it shall disclose the following. First, the period covered by the FS. Second, the reason for using a longer or shorter period. And third is the fact that the amounts presented in the financial statements are not entirely comparable. For the comparative information general feature, the standard requires an entity to present comparative information in respect of the preceding period for all amounts reported in the current period's financial statements unless another IFRS requires otherwise. As a minimum, an entity presents two of each of the statements and related notes. For example, when an entity presents its 2020 current year financial statements, the 2019 preceding year financial statements should also be presented as comparative information. Your last general feature for the financial statement would be the consistency of presentation. The presentation and classification of items in the financial statements is retained from one period to the next unless a change in presentation. First, if the change in presentation is required by an IFRS, or if the change in presentation results in information that is reliable and more relevant. A change in presentation requires the reclassification of items in the comparative information. If the effect of a reclassification is material, the entity shall provide the additional statement of financial position as discussed earlier.